March 2023 was a terrifying month for the banking industry.
The new concerns following the collapse of the 16th largest bank in the U.S., Silicon Valley Bank.
A rough week for the banking industry.
The collapse of Silicon Valley Bank. It's the second biggest bank collapse in U.S. history.
Two big bank failures are roiling the financial market. But here's why more trouble is coming.
4 major banks have collapsed in the past month, and there are rumors that more are on the way. If the banks continue to fail, it could lead to another global financial crisis.
The management of these banks will be fired. Investors in the banks will not be protected.
But who is to blame? Could it be the banks themselves, using their legal but unethical tactics to make profits for their shareholders?
And my dad said I need to put it in the bank so it can grow over the years.
We can put that check in a money market mutual fund, and it's gone.
What do you mean? I have $100.
Not anymore, you don't. Poof.
What if I told you one man was able to beat the banks at their own game and was able to generate wealth for his family, and till this day his family are considered one of the richest in the world? Who is he, and how did he do it? This video will show you how to beat the banks at their own game and protect yourself from getting scammed by them.
Banks can lend money that they don't actually have. It's a criminal scandal, and it's been going on for too long.
Let's start with what banks are exactly. Contrary to what you might think banks are, they are just like any other business. They all want to make money. Banks make money by lending out your money. They utilize a method called fractional reserve banking.
Fractional reserve banking is the biggest scam known to man. You can literally loan out money that you don't have. If you have $100, you can loan out 1,000 and charge interest. It's a Ponzi scheme.
If this is true, then how do you stop the banking system from profiting off you? Well, that's exactly what this guy did, whom we are about to talk about next. He beat the banking system, and you are about to learn how he did it. John D. Rockefeller, born on July 8, 1839, was no ordinary guy. In fact, he was one of the wealthiest individuals to ever walk the earth. But how did he accumulate his fortune? Well, think of him as the Elon Musk of the late 19th century, only with oil instead of electric vehicles. During the financial crisis in 1907, Rockefeller stepped up like a true financial superhero, donating a staggering $10 million to help bail out one of the biggest banks in New York at the time. He also pledged half of his wealth to maintain U.S. credit. Rockefeller's actions helped to restore confidence in the banking system and prevent a wider financial crisis. But here's where it gets even more interesting. Rockefeller wasn't just sitting on piles of cash. He had a financial ace up his sleeve. He was the master of using life insurance to become his very own bank. Picture it like this. Imagine you could borrow money without putting your house or car up for collateral. Well, that's exactly what Rockefeller did. He took out loans against his life insurance policy to invest and generate more wealth. The man just kept getting richer and richer. But that's not all. Rockefeller didn't just stop at his own policies. He invested in life insurance policies for each of his family members, growing his wealth without getting tangled in other assets. And then, Rockefeller created a trust to hold and govern his life insurance policies. The trust he created generated wealth, and he was able to control his money even after he died. Talk about long-term thinking. So what's the point of having a trust? Well, when you own something, it's like hanging a juicy steak in front of hungry wolves. Everyone wants a piece, from the taxman to private investigators. But what if you could own it and control it without your name plastered all over it? That's the magic of a trust. No liability, no excess taxes, and definitely no unwanted fame. So, what is a trust? Think of a trust as a secure vault, a legal entity that operates much like a bank for your assets. In this vault, you, the trustor, hand over the keys to a trustee, an entrusted guardian. They manage and protect your assets inside the vault for the benefit of a third party, the beneficiary. Now, why might you consider setting up a trust? Well, it's all about control. By placing your money or assets in a trust, you technically relinquish ownership on paper. However, if you're on the board of trustees, you still call the shots. The sweet part? Trusts don't get taxed, allowing you to use your money and assets as you see fit. Worried about lawsuits? Don't be. The money legally belongs to the trust, not you, so you can't lose what you don't legally own. And in the event of your passing, your children can seamlessly take your place on the board of trustees, avoiding hefty death taxes on personal assets and money. Once your trust is up and running, it's the trustee's job, either you or your children, to manage the assets and distribute them as per the trust's terms. Besides steering clear of extra taxes and rules, a trust can also shield your stuff during a divorce. If you split up, the things or money you stash in a trust can't be taken because they legally aren't really yours. Don't believe me? Check this out.
Now a billionaire divorce showing how the trusts can also be used against ex-spouses.
Ed Bossarge discovered an obscure financial tool that critics say allow the rich to hide their wealth from tax authorities and from spouses. In a lawsuit, Marie said that during their marriage, Ed secretly put virtually everything they owned.
That's exactly what I was saying. The money legally belongs to the trust, not you, so you can't lose what you don't legally own. In that unfortunate case, it appears Ms. Marie got the short end of the stick. Now that we know about trust, how does life insurance come in the equation with becoming our own bank? When most people think about life insurance, they envision it as something that only pays out when you're no longer around. That's called term life insurance, and yes, that's pretty much true. Moreover, life insurance in general is just a contract. If you outlive the contract agreement for your term life insurance, then you are no longer covered. By that time, companies will only give you enough insurance to bury you and not enough to leave behind to your family. On top of the high premiums, they will charge you to enter another term agreement. Insurance companies often advertise term life insurance because it's the most profitable for them. Most people outlive their contracts while the insurance companies profit from all of the monthly payments you've paid throughout the term of the agreement. It guarantees a payment to your beneficiaries if you pass away during a set term, but that's it. No fancy extras, no savings account attached. But hold on, it's time to renegotiate the contract, like one utilized by John D. Rockefeller himself. Whole life insurance. What sets it apart? Well, it's permanent and lasting as long as you're paying those premiums. Plus, it's got a cash value account, like a tax-free savings account you can access while you're alive. Ever wonder how the Rockefellers made money with life insurance? Simple. They created whole life policies for the entire family, consistently paying high premiums. Over time, the cash value grew, allowing them to borrow against it for investments. This borrowing is tax-free money, and you don't even have to pay it back as it comes out of your death benefit. Life insurance, in this sense, becomes your personal tax-free bank account. The rich use this strategy to invest and grow their wealth. It's all about leveraging those tax benefits. Now, how do you access that cash value? It's easy, no credit checks, no approval process. Just talk to your insurance company, request a policy loan, and use the money to invest and generate wealth. Plus, it doesn't count as income, so no taxes are involved. The Rockefellers took it a step further, tying their life insurance to a family trust. When any Rockefeller passes away, the insurance payout, which is tax-free money, goes into the trust. This is how they've maintained their status as one of the wealthiest families in the world for a very long time. Now, let's talk about the bigger picture. Beyond life insurance and trusts, a family foundation comes into play when wealth accumulates. It is at the bottom of the financial structure. It's about being charitable and giving back, which is a vital part of managing substantial wealth.
In 2006, he pledged to eventually give away all of his Berkshire Hathaway shares to philanthropic endeavors. As of today, he's made a yearly contribution of shares, this time around worth $4.1 billion.
Is Warren Buffett just being nice, or is he using another tactic that the Rockefellers used to hide from paying taxes? Now, in the world of finance and wealth management, foundations are a great tool to utilize because it shields you from paying taxes and makes you look like a philanthropist in the process. It's basically a win-win scenario for everyone. Legally, you're only obligated to allocate 5% of your foundation's funds to charitable causes. As for the remaining 95%, you have flexibility in how you use it. You can use it to compensate family members, create a lasting legacy, or pursue other financial goals. The best part? No taxes when you put this money to work for your chosen purposes, as it's designated for charity. This practice is commonly embraced by affluent families who establish their private family foundations. It allows them to fulfill legal requirements, maintain control, and strategically utilize their remaining resources. Moreover, when properly managed, these foundations can be passed down through generations, serving as a conduit for wealth transfer. Rockefeller created the Rockefeller Foundation. This foundation not only left a lasting impact on society through education and medical advancements, but also served as a method for preserving non-taxable wealth for future generations. In essence, when you've accumulated wealth through investments, life insurance policies, and trusts, consider allocating a portion to a foundation. Foundations don't generate money independently, they rely on donations. Right now, you can try Shopify free for 14 days, followed by 3 months for just $1 per month. That's literally paying $3 for 3.5 months of service. To sign up, click the link below and use my affiliate link to get this offer. You'll be glad you did. In conclusion, trusts, life insurance, and foundations all can work together to safeguard your wealth, help it grow, and support future generations of your family. Trusts manage assets efficiently and protect them. Life insurance offers a smart way to manage wealth and ensure family financial security, and foundations help to keep wealth for future generations, like the Rockefeller family did. All these are best handled with a family office, which helps to keep everything in order. However, these strategies aren't one size fits all. You should consult a legal and financial advisor before making any financial decisions. If you found this video helpful, please show your support by liking, commenting your thoughts on this video below, and subscribing to our channel. Thanks for watching. Now go really get money worldwide.